Hey there, everyone. Brian Schul with Straight Data Science. So, in the topic today, I want to look at flagging high risk loans. Okay, we're going to do this in an automated fashion based on some business rules and just customized logic that I created, right? But very realistic. I created this data because I couldn't find what I really wanted online. So, if you can't find it, you just create it for yourself, but it's all based on reality, right? So, it's very, very realistic. And we're going to try to understand how these loans work based on transaction history, creditworthiness, and regulatory trends. So let's start at the beginning. We are going to introduce a couple concepts of clustering, DBSCAN, and K-Means, and try to look for anomalies based on these financial transactions and these rules that we are going to develop. And again, I'm going to give you all the code. I do this for all my videos. I share all the code with everybody so you can download it, copy and paste it, and run it in your own environment and learn from this example, right? I think, interacting with the code, you can change a few different things and see what kind of impact that has. I think that's the best way to learn. Very interactive, very dynamic. If you just go read it in the book or just I don't know, just watch a video and somebody's talking to you, you're not going to learn that much. If you interact with the code and you copy and paste it and run it in your own machine, you're going to learn a lot more that way, okay? So what is unsupervised learning? Basically, we don't know what the outcome is supposed to look like. The machine is going to tell us. That's what clustering is, right? There's two types of machine learning. There's supervised learning, where you know basically what the outcome should be. You define that and you tell the computer what it should be. That is regression and that is classification. Clustering is different, right? It's unsupervised. We don't know what the outcome is going to be. I just take everything, dump it into a big blender, and I tell the machine, you tell me what I need to know, okay? So I'm going to learn from you. I'm not going to tell you what to do. You tell me what to do. That's what the difference is, okay? And we're going to flag outliers as potentially suspicious or some type of anomaly. So here's the data I created, right? I couldn't find exactly what I wanted online, so I just created it myself. We have credit score, debt to income ratio, loan to value ratio, number of late payments, volatility, large cash transactions, and so on and so forth, okay? And what potentially is high risk, the amount, the transaction over time, and then the hour of the transaction. So some of these, sometimes the time of day or the day of the week, maybe even the month of the year can matter. Probably it's more like the time of the day, to be honest, but the time can play an impact on potential fraud transactions, right? Like in the middle of the day, is there going to be a lot of fraud? Maybe, maybe not. Overnight, there's probably going to be more fraud, right? Like there's less people looking at it, less people paying attention, and it's just easier to get away with things when it's dark outside, right? So let me hit Control Enter to refresh this. Control Enter, we can see the distribution of risk here and then the frequency. So we have the counts over here, count 87, 82. This is a Plotly chart. I use almost exclusively Plotly charts. I like this a lot because it's dynamic, it's interactive. You can actually zoom in and zoom out like this, right? We can see all the details here. Double click and get back to normal. So the 90th percentile is kind of a common way to show, okay, what's the high risk score over here, the top 10% of risk, the bottom 90%, I'm not too concerned about, but I would probably focus on the top 10% of risks. 90% that is not super risky is not going to consume too much of my time. So let's look at the top 10 risks right here and sort those in descending order. So ascending equals false meets descending, right? And we have the risk score, which is, oh, let me see, where is it? By risk score. I don't see it. Where's the risk score over here? Sorry about that. Oh, risk score, I do see it over here. Okay, so risk score, that is the risk right there. And it's next to rule flag. Oh yeah, there it is. Okay. I gotta get glasses. My eyes are getting so bad now I can hardly see anything. Okay, so we have the risk score in descending order. So these are the top 10 risks in the whole portfolio. So this is what we want to be aware of. This is what we want to keep an eye on, right? So the whole thing with making loans or mortgages or lending money to people, you want to lend as much as you can because all those transactions are going to generate revenue for you, right? But if you lend to everybody in the world, some people are not going to repay their loans. they're just going to get the money and walk away after making 1 or 2 payments, maybe after making no payments, right? So you want to minimize the exposure of your risk by lending to fewer people, fewer high risk people. You want to make loans to the low risk um, individuals, right? So you can't lend to everybody. That would create more money, but you would lose a lot of money. You would lose more than you were making. But you can't turn off your operation and lend to nobody. That would be 100% risk safe. You're not going to lose any money, but you're not making any loans either, right? So your business is going to wither up and die. So the goal is to balance how many loans you make and to who you make the loans, and to try to avoid the high risk loans and try to absorb or issue to the low risk crowd. Okay, that's the whole goal here. So let's hit Control Enter to refresh, and we have our machine learning model. This is a random forest classifier. If you've seen my other videos, you know how this works. Precision, recall, and F1 score, higher the better. Okay, so we have some pretty high numbers. 1.0 is perfect. Usually you don't get to 1.0, but that's fine. You can do all kinds of hyperparameter tuning. I've got a video about that. And you can undersample from the larger population, oversample from the smaller population. There's ways to do that using SMOTE. I have a couple of videos on that. I'm not going to get into all that. It's kind of a different topic. But we want to look at the feature importance, and this basically is the explainability of the model. So what has the most impact when I set the target variable? If I say, okay, this is high risk. This is what high risk looks like. This is the definition of high risk. How do I determine what features are going to impact the high risk? Is it going to be the credit score? Is it going to be the DTI ratio? This is the debt to income ratio. So here's credit score, DTI. Is it going to be loan to value ratio? This is the LTV. Number of late payments, is that going to have an impact? Tax transaction volatility, is that going to have an impact? Large cash transactions, is this large or not large? Know your customer, complete, so KYC, know your customer, and risk score, and that is over here. So which feature is going to have the most impact on the high risk definition of how we define this as high risk or not high risk? What features are going to have the most impact on that? Can you look at this and tell me? I can't tell. I don't know what this is. Like, I'm just looking at it, I'm just trying to understand it. But with the feature importance exercise, we can determine which features are going to have the biggest statistical impact on high risk. Basically, risk score. That makes sense to me, okay? So what other feature importance is going to have an impact on high risk? Large cash transactions. That makes sense to me, okay? So large cash, if you're lending a lot of money, this could be a risky proposition. Maybe you'll get the money back, maybe you won't get it back, right? You'll get more interest, you'll make more money on some of these transactions, but not all. Debt to income ratio, again, makes sense, right? This totally makes sense to me. I didn't know that initially, but if you have a lot of debt and low income, you probably won't be able to repay the loan. You're going to lose the money. Credit score, that definitely has an impact. Number of late payments, totally makes sense, right? Loan to value ratio, transaction volatility, and know your customer, complete. So know your customer is like, how well do you know this individual that you're lending to? Have you done business with them before? Is this does the person live in a country that we probably shouldn't do business with? Maybe Iraq, Iran. Has the customer had history of late payments or not making payments, right? So understand your customer, but that has a much less impact on the risk. Of the loan that we're making than the risk score, the large cash transactions, debt to income ratio, credit score, and number of late payments. Those are the top 5. Okay, so unsupervised learning can help us tease out different outliers or different anomalies or whatever you want to call it. Do you have labeled data as fraud or anomaly data? If you don't, you can actually create this data if you don't have it. And some of these data sets don't. Like sometimes you could say, okay, I have all these features like I'm just showing you right now: risk score, large cash transactions, debt to income ratio, credit score, number of late payments. But do you have an actual feature that says this is a risky loan, don't issue the money to this person? If you have that, that's great. If you don't have that, you have to manufacture it. You have to create that yourself, right? So we can do that using clustering technique, right? Because again, like I said a few minutes ago, we don't know what the outcome is going to be. We can't define this, and we don't have that built into the data set, unfortunately, but we can define that and create that constructively, right? This can be a construct that we initialize and that we create based on all the inputs of these other features, right? So K-means clustering is simple, fast, and works well on globular clusters, and DBSCAN detects arbitrary shapes or clusters, naturally flags outliers, right? So these are two different clustering techniques. We can use both. I think K-Means is probably the most popular. DBSCAN is density-based scanning. And if you have a few outliers and just a density of these outliers, but they're spread around and you don't really know where they are, we can tease these out pretty easily using DBSCAN. That's what this technique is good for. So we can pre-process the data. We want to scale everything. We're using a scaler right here. Basically, a scaler will take everything and kind of like normalize it or standardize that, so we can look at these different clusters or define these different clusters, right? Like if you have something that's way out in left field or way out in right field, that's fine. We want to take everything and kind of normalize it and kind of harmonize it and bring it together. And then we can do the analysis. If you don't do that, you can still do the clustering, but it's just good practice to standardize it or to scale the data set to do the clustering more efficiently and just in a more refined manner. It will actually help the model to run faster and produce more accurate results. So you don't have to do that, but it is good practice, right? So let's look at the data frame now. We just defined the cluster as anomaly K-means, so we added that as an append over here to this data frame that we had before, right? If we go back here, this ends in hour of the day. We're saying like overnight transactions might be more suspicious, and we're looking at the hour. So the new feature that we just created based on anomalies or outliers, or is this different from the normal data set? False, false, false. So these are all non-anomalies, right? And that's fine. So that was the K-means. That's the first technique that we use in DBSCAN. Is the next. This is anomaly DBSCAN. Let me run this. So we append this as a new feature on the data frame. And we have anomaly K-means, that's what we just saw, and then anomaly DBSCAN. So these are all false, that's totally fine, right? But we're looking for the actual like outliers, and this is just the head of the data frame, right? So we're just looking at the first 5 records by default. If I showed the entire data frame, there would be some outliers. I'm just looking at the first, just for peace of mind, or whatever it's called. What is it? Peace of mind, or sanity check, just looking for a quick sanity check just to make sure these things are working, and they are. So the last thing I'm going to do here is create a chart so we can see everything. So I'm just displaying the first 5 records. This chart is going to display everything. An anomaly is true if it's red, and it's false if it's blue. So we do see a few anomalies over here, and these will have credit scores that are pretty high, right? Like or pretty low. They have low credit, and the debt to income ratio is very low, right? So that's why this can be anomalous, and that's why we have to look out for these types of loans. And we would either maybe not even issue the loan, maybe issue like half of the money that the person's looking for, or not issue it at all. But these demand more scrutiny, and we have to have like a person follow up, or like a loan administrator or loan manager, like just give this a little bit more focus, give this a little bit more attention, because these loans could produce a lot of money for the institution issuing the loan, issuing the money, right? Granting the loan, but not necessarily. So either we have to have somebody have eyes in this thing, or maybe give half the money that the person's looking for, or give none of the money, right? If it looks like super high risk. So you can define these into different categories too, right? Like we have to have eyes in this, and we'll probably issue the loan, issue half the money, or we're not even going to do transactions with this person because it's so high risk, it's not worth the effort. Okay, so that is it. How to flag high risk loans and analyze transaction history, creditworthiness, and look at regulatory trends over time. Okay, so that's it. Hopefully this was informative and useful and educational, maybe even inspirational. I try to make it like inspirational, but I don't know if I achieve all that, hitting on all those goals. But hopefully at least this is the truth. This is straightforward. This is how these things get done, and hopefully that was useful for you. So I'm going to wrap it up here, and I will see you guys in the next video. Talk to you soon. Bye.